Welcome to TheoTrade. This is Don Kaufman. It's November 11th, 2019, and you are watching the TheoTrade evening video. First and foremost, I want to thank all of our veterans, past, present, future. If you served, thank you on behalf of everyone here at TheoTrade. To the markets, it's a slow day. Why? Well, it's a federal holiday and the bond market is effectively closed. I figured, what better time to discuss the dynamic of interest rates when, of course, the bond market is effectively closed. And right now and moving forward, people, it's all about rates. Rates, they're going to define the path forward for this entire marketplace. And I'm going to give you a little bit of a convoluted dynamic, nevertheless a dynamic that we are really coming right up against right here, right now. This week, next week, okay, we're going to be facing, again, a very strong dynamic involving rates in this marketplace. Let's get down to it. Let's start with the TNX. I think this is possibly the best way to kind of delineate what's going on in the interest rate environment. Now, if you've never looked before at the TNX, yes, it's quoted as 19.43, but don't let that confuse you. What that really breaks down to here is, well, first and foremost, the TNX is representative of the 10-year Treasury index. It's the interest rate associated with the 10-year. That breaks down to 9.43%. That's pretty much what your 10-year is paying right now. Now, all right, why the discussion? Why this dynamic that exists? Well, if you look back just a month ago, we had that 10-year, that very same 10-year sitting at roughly 1.5%. Well, what's occurred inside of the last just few weeks of trade? Because here we are right there. It's pretty much the beginning of October. Here we are, today, just a few days into the month of November. But over the course of about a month, I mean, we've had close to a half a full percent increase on that 10-year, which is ripping. And at the exact same time, you've actually seen the Fed do what? I mean, the Fed in just the last few weeks has actually lowered rates, but they're lowering Fed fund futures rates, and they've lowered just a week or so ago, they lowered quarter point. The quarter point before that, I mean, we've had the third rate cut, and yet at the exact same time, the rates have done nothing but go up. Now, we're starting to hit, as I said, this kind of inflection point. The market's feeling maybe a little bit better about itself. Yeah, but the cost of carry is really starting to take off. And when you start to get above specifically, we'll call it this 2% threshold, it's when everybody's going to start to get nervous. Where are they really going to get nervous? One of the first things you'll see is things like home builders, XHB. Let's pick off what I would say the low-hanging fruit. The XHB, which is representative of the home builders. All right, well, what are some of the home builders? Maybe KBH. What else you got? I don't know. We could go take a glance over at Toll, PHM. I mean, I can go here for a half an hour bringing up different home builders. But again, you guys see when I say like low-hanging fruit, let's go look specifically at a few of them. Have any of these individual stocks backed off? You wouldn't know it by looking at like Toll. Looking pretty good. Earnings, well, the earnings are coming out in about a month from now, but again, still hanging in there pretty tough. Take a look at PHM, Once again, hanging tough, doesn't seem to necessarily be impeded by those interest rates. And last but not least, we'll just jump over to the XHB, which is the kind of the generalization. It's the ETF. Again, showed mild signs of weakness, nevertheless, bid back up today. Again, net, we haven't really seen the fast move up on that TNX really start to impede against the home builders. I've even gone so far as to look at things like, Lowe's, which is, again, towards the top of the range, Home Depot, which looks like a freight train to the upside, maybe coming off a little bit, but earnings right around the corner. Again, you just haven't seen these sectors impeded. Well, what else kind of comes to mind? What really comes to mind, again, when we start to look at the TNX, and again, I'm looking for some low-hanging fruit as we start to go up on the interest rates. Okay, what's really going to be impeded upon? There's no question, big dividend payers or like a safety trade. The safety trade has been XLU. What is it? It's utilities. And that's something that we've absolutely carried positions in. Specifically, we've been carrying positions in here because, well, we're looking for just that. Is the safety trade going to break down? So XLU is coming off a little bit. But this is where you want, again, when I say looking for some low-hanging fruit, what are some of the big dividend payers? I always think of something like Verizon. All right, Verizon, maybe mildly backed off, but nothing. But if you take a look at Verizon, and it's, again, a heavier dividend payer, about 4%, then you'd have to throw something like AT&T into that category as well, which is at a 5% dividend and is effectively, wait for it, pull up the maximum chart. It's not at its all-time high. Yeah, you have to go all the way back, of course, to the internet bubble for that one. But it's at the recent all-time high, if you will. Nevertheless, these are what I would consider, again, some low-hanging fruit surrounding the idea, okay, if interest rates continue to rise. Now, in addition to that, when I say we start to hit like kind of inflection points in the markets, interest rates rising is kind of what they call the reflation trade. This is where everybody's starting to feel a little better. The interest rates can come back up, but if they continue to come up to a point, it will literally start to snap and domino sector after sector after sector after sector. And we believe that we're relatively close with that. Coming across, again, that 2% threshold. Listen, that 2% threshold, it really didn't mean all that much just back here in that July timeframe coming underneath it. But now coming back above it, well, that doesn't necessarily mean that free money for everybody. And again, this is the kind of dynamic that we're up against in just the next few trading sessions, weeks, months. Again, it's all about interest rates. They're going to define this market's path forward, and you got to get in tune with it, because I'll tell you what, if these bonds break to the downside, eventually markets will start to panic a little bit. But at the exact same time, okay, if the bonds turn around and start to rally again, the only way that we view the bonds really starting to rally again, okay, is if the S&Ps are actually selling off. So we're in this almost catch-22 situation, a lot to think about, a lot more on this front here at TheoTrade all throughout the rest of the course of this week. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.